As we look at the second half of the year, the sentiment is that we're getting closer and closer to rate cuts, very possibly in September. What does that mean for fixed income?
Yeah, you're absolutely right. I think the CPI data that we received this week, combined with the cooling, although not collapsing, of the US labor market, and Fed Chair comments where he said that the central bank is placing similar or equal importance on both sides of its dual mandate, all of that does pave way for a September Fed rate cut. Of course, we've still got two more inflation prints, two more jobs data between now and then, but this is good news. As the Chicago president said last night, it does demonstrate that we're on the path to 2%. From an asset allocation standpoint, this really underscores the importance of rotating into bonds, locking in those attractive yields before the cutting cycle begins. And then I think within portfolios, one of the ways to position for this, at least for our clients' portfolios, we believe, is to position for the US Treasury yield curve to steepen, because the front end of the curve will benefit from those impending rate cuts, while the longer end exposure is aligned with the fact that we'll see higher supply and fiscal dynamics as well.
You know, Gurpreet, that's really interesting. I was telling a guest earlier today, I was speaking to a managing director at a big bank. They've seen a flurry of long duration bond buying since the debate. A lot more, the jobs report. I keep saying the debate because obviously the debate's a big news item right now. But since the jobs report, when sentiment seemed to shift that we're going to get the rate cut sooner than later, is that what you're seeing as well? A lot of people looking to lock in those long duration bonds. And then what do you think that could mean for the equity market as we look at the second half of the year?
Yeah, look, I think for the equity market, what matters is what is driving this easing, because right now it is an adjustment cut cycle that is expected and priced, because the economy is still relatively sound, fundamentals are still good, the fundamental picture is decent. And so the adjustment in policy rates is due to the slowing of inflation and cooling of labor markets, which can be positive for risk sentiment, including risky parts of the fixed income market, but also by extension equities. And to the first part of your question, yes, absolutely, you are seeing interest for fixed income. We've seen that renewed interest since we moved into this higher yield environment. You've seen pension funds de-risking, looking to move into fixed income. In our 13th annual insurance survey, we saw the interest in fixed income at its highest since that survey began. We also see households who'd moved into money market funds looking to engage in fixed income, some for the first time. And so the fact that fixed income once again does deliver income is really opportunistic and attractive. So it's a really interesting time to be in fixed income market.
So, Gurpreet, let me ask you something. I would imagine a lot of your clients are asking you, as you look at corporate debt right now, if rates are definitely on the way down, doesn't that make more parts of the corporate debt landscape a bit more attractive? I mean, obviously, you know, investment grade and Apple's corporate debt's always going to be attractive, but doesn't that kind of broaden out, I would think, what other investors are looking at right now?
Yeah, look, we think there are interesting opportunities in corporate bonds. When you look at the fundamental picture, fundamentals are sound. Interestingly, higher rates have actually instilled discipline among corporate managed teams in terms of how they manage their balance sheets. And that's good for us as a credit holder. You see decent interest coverage ratios. You've seen open capital markets have allowed many corporates to come to the market this year and issue new bonds to address refinancing risk. And actually, investors have snapped up those new issues. And so you've seen solid new supply being met with resilient demand from investors looking to capture those yields. And coming back to my earlier point, if the Fed begins its adjustment cycle, whilst you may see that fully reflected in the US Treasury market, in the rates market, and perhaps the currency market, markets are still relatively inefficient, and it's not yet fully priced into corporate markets. And so if that adjustment in policy rates is occurring against a still resilient growth backdrop, there can be opportunities to rotate into, say, high yield corporate bonds as well.